Welcome to this explainer. If you've been watching the markets lately, it's pretty clear space is the ultimate frontier, not just for humanity, but for capital. So today, we're diving into the absolute monster that was the SpaceX IPO. But we're actually going to use it to decode something else entirely, the mathematically fascinating, yet incredibly dangerous world of leverage trading. Wall Street loves to engineer financial products to multiply our excitement, but today we're focusing on exactly why leverage trading carries such immense risk, and we're going to use the hottest stock on the market to prove the math.
Okay, we've got to start with this absolutely staggering number, $75 billion. That is how much SpaceX raised back in June of 2026 under the ticker SPX. It officially became the largest IPO in history, debuting with a valuation well over $1 trillion. This wasn't just some successful public offering, it was a literal seismic event that forced massive institutional repositioning across the entire market.
And look, this IPO wasn't just built on hype and cool rocket launches. It was built on real, massive structural disruption to legacy industries. The CEO of Charter Communications actually admitted that traditional telecom giants, companies like Comcast and Charter, lost over 1.1 million broadband subscribers to Starlink in 2025 alone. They're losing real customers to a satellite constellation with a huge structural cost advantage. So you've got a globally disruptive company literally rewriting the economics of telecommunications. So, with a story this exciting and disruption this profound, active traders immediately start asking one very tempting but very dangerous question. How can I double my exposure, right? Because when a stock has this much momentum, human nature just totally takes over. People don't just want the normal gains of SpaceX, they want to magnify their potential profits, and ideally, they want to do it without the headache of opening up a traditional margin account.
Which brings us to the 2x leverage temptation and how the market eagerly answers that exact desire by rolling out specialized derivative products. Wall Street is incredibly efficient at packaging what traders want and selling it right back to them. Enter the SPCX ETF. This is the leveraged shares 2x long SPCX daily ETF. It's got a 0.75% expense ratio and it uses financial derivatives, like total return swaps, to target 200% of SpaceX's daily stock performance. So basically, if SpaceX goes up 1% today, this fund is engineered to go up 2%. Sounds like an absolute dream vehicle for anyone who believes in Elon Musk's vision, right?
Well, here is the crucial bait and switch that catches so many novice investors completely off guard. The expectation is that you can just buy this ETF, sit on it for a year, and seamlessly double your long-term returns. But the reality is a completely different story. This fund is strictly designed for daily or intraday holds. Notice that word daily in the fund's title? That is not just some clever marketing term, it's a strict, undeniable mathematical boundary.
And to understand why you absolutely cannot just buy and hold this thing forever, we really need to unpack the daily rebalancing trap. This is the absolute core mechanism of why these funds operate the way they do and why leverage trading carries such profound risk.
So let's look at the hidden plumbing here. Every single day, the fund managers have to use total return swaps just to track the daily performance of SpaceX. Then, right at the end of the day, they are forced to completely rebalance their positions based on the fund's new net asset value. They literally have to reset the leverage ratio back to exactly 2x for the next morning's opening bell. They're constantly, endlessly buying and selling derivatives just to maintain that strict daily multiplier.
And that constant daily resetting, it creates a massive hidden mathematical trap for long-term holders. If you take away anything from our analysis today, please make sure you understand these next two financial concepts.
First up is volatility decay. Think of this as the slow erosion of your investment's value over time, when those daily leverage returns compound during choppy up and down market conditions. It's essentially compound interest, but working completely backward against your money. When the market is bouncing around, that daily resetting mechanism we just talked about starts actively eating away at your principal.
And that directly causes what we call beta slippage. Because of this bizarre compounding math, your returns over a period of weeks or months are going to experience severe beta slippage. This is a massive divergence where the leveraged ETF's long-term performance completely disconnects from the underlying asset's actual performance. Over time, I promise you, your SPCH shares will look absolutely nothing like a simple 2x multiplier of the regular SpaceX stock chart.
Let's actually trace the numbers so you can see the math in action. It's incredibly eye-opening. On day one, both the stock and your ETF start at $100. Great. On day two, SpaceX drops 10% to $90. Because you're leveraged,
Your 2X ETF drops 20%, down to $80. Now on day 3, SpaceX rallies 11.1% to get right back to its original $100 price. But for your ETF to recover from $80, it needs a 22.2% gain. It gets exactly that, twice the daily SpaceX gain. But 22.2% of $80 only gets you back to 97.77. So the SpaceX stock is completely flat for those 3 days, but you have permanently lost over 2% of your money. That right there is volatility decay in a nutshell.
Now let's connect this cold financial math directly to the actual physical reality of space exploration, because SpaceX is exceptionally vulnerable to this exact type of volatility, making a 2x leverage fund incredibly dangerous. According to SpaceX's own S-1 filing with the SEC, their operations face extreme, highly visible physical risks. I mean, space is an inherently hostile environment. We're talking about massive rockets bursting into flames on the launch pad, extreme thermal cycles, cosmic radiation frying delicate satellite components, and the literal, constant threat of micrometeoroids. Any single one of those anomalies, or a highly visible failure, can cause an absolutely massive single-day swing in the stock price.
Which brings us to a crucial, terrifying threshold: 50%. When you combine the immense physical risks of exploding rockets with the mathematical risks of leveraged derivatives, 50% is the number that should legitimately keep you up at night. Because what happens if a catastrophic physical failure causes SpaceX stock to drop by 50% in a single trading day?
Well, if that underlying stock drops by half, the math of 2x leverage dictates a 100% loss. This means your entire investment in the SPCH ETF goes to absolute zero. It is permanently wiped out. And here is the brutal truth about financial math. Once an investment hits zero, it cannot recover. Period. Even if SpaceX fixes the rocket, launches flawlessly the very next week, and eventually builds a thriving, beautiful colony on Mars, your portfolio is already gone.
This physical and mathematical reality forces us to draw a really hard line between trading and investing. Confusing these two behaviors when leverage is involved is exactly how capital gets totally destroyed.
Look, a leveraged fund like SPH is a highly specialized, very powerful tool for a fast-moving, short-term day trader. If you're looking to exploit daily momentum, like maybe capitalizing on the news of a successful Starship launch right at the opening bell, it works precisely as designed. But it is a guaranteed wealth destroyer for a patient, long-term investor who's just trying to hold the asset for years while waiting out inevitable orbital delays and complex manufacturing hurdles.
And hey, if you still don't believe me, just look at the SEC-mandated warning printed directly in the fund's own prospectus. It plainly states the fund will lose money if the underlying stock performance is flat over time. Notice it doesn't say it might lose money. It guarantees a loss in a flat market purely because of that underlying math of daily rebalancing and compounding we just walked through.
So as we wrap up this explainer, I really want you to ask yourself a serious question. When you look at a globally disruptive company like SpaceX and you consider buying a leveraged derivative like SPCH, are you actually managing the profound mathematical risks of your financial tools? Or are you just getting carried away by the hype of the stars and blindly betting against tomorrow's math? It's crucial to understand the tools, respect the decay, and invest wisely. Thanks so much for joining me on this deep dive.